All right, we're going to talk with Stephen Schork now. Stephen Schork is the co-founder and principal of the Schork Report, which is a daily subscription newsletter on energy and the financial markets. Schorkreport.com, and you spell that S-C-H-O-R-K report, S-C-H-O-R-K report.com. And let's get him on here because there's a million things going on. Stephen, welcome.
Yeah, it's great to be here. Thank you.
Can you explain, to the average person listening, something happens in the morning related to this Ukrainian war, and it seems by time they're driving home from work, gas prices have shot up considerably. Why does it happen so fast? Because the gas that they're pumping this afternoon, well, that was taken out of the ground months ago.
That's right. And it's an economic phenomenon that the Federal Reserve Bank of St. Louis detailed called rockets and feathers. So what we tend to see here in a situation like this where there is significant supply scarcity and we are getting $10, $15, $20 per barrel spikes in the price of crude oil. So those prices are rocketing, and the retail prices are going to rocket as well in anticipation. While it is true that the gasoline in tank was purchased with crude oil prices lower, once that gasoline runs out, you're going to have to replenish it now with gasoline that is much more expensive. So that's the rockets phase of it. The feathers is that when crude oil prices do pull back, you tend to get a soft, like feathers floating to the ground, a slower reaction from retailers because they're losing money in this high-priced environment, and they will make it back by lingering, feathering those price increases into the future. That will be determined by competition. If there's another station across the street that's lowering prices, you have to compete. But essentially, it is the fact that we are in unprecedented, uncharted waters right here. Oil prices are jumping $10, $20 a barrel, and that is having an immediate effect on wholesale prices, prices that are priced tomorrow. Those physical prices are jumping, and the retailer is looking at their supply and knowing where they have to replenish it. So they need to raise their price so they can go ahead and buy it from the refinery.
So we're paying for the replacement cost of the gas we're putting into our tank.
Effectively, yes, and then there will be that lag. That's an apt way of describing it.
You say that the climate change policies that Biden has pushed are responsible, I guess, in part for this situation. Talk about that.
Yeah, absolutely. The green agenda is a zero-sum game with the way it's being pursued. And as we just saw in Germany, where natural gas prices are trading above the equivalent of $400 crude oil, the Germans have made an about-face and realized they have to embrace fossil fuels, natural gas to an extent, in addition to renewables. Here in the United States, we've gone whole hog, and we've violated the primary tenet of economics, and that is capital goes where it is welcomed and stays where it is well treated. And when we see the administration and their rhetoric and their actions their first week in office, when we look at the way ESG has invaded the corporate boards of the major oil and gas companies, CapEx is not being put towards fossil fuels. The focus is on decarbonization. So we've underinvested, and we continue to underinvest, and it's that signal to the market where we're simply not bringing the supply to the market, into an environment, into a government that is hostile to the industry as a whole.
You said something about ESG. Explain what that is.
Yeah, absolutely. That is the environmental movement, the Wall Street movement to go ahead and invest wisely, i.e., divest from traditional oil and gas production and move it more towards renewables. I am certainly pro-renewable. Solar power in your neck of the woods in Southern California works extremely well. Solar power in my neck of the woods, Philadelphia, not so good. So you do need to see a balance, but the ESG has pushed it all one way. Again, zero sum, and we are all now paying that price for a lack of investment into the BTUs that work 24 hours a day. The sun only shines a half the day. The wind only blows a certain part of the day. Natural gas can burn every single minute of the day.
Well, that's very logical, but how come the crowd that's so big on climate change and we got to move to all renewables doesn't seem to get that.
Yeah, the problem here is that too much of a good thing. So we're actually going to see coal use around the globe increase. U.S. coal production, U.S. coal exports will rise and are expected to rise over the next 2 years. Emissions of CO2 after a decade of declines, CO2 emissions are now rising because we forced the hand. Whereas the renewables cannot do it by themselves, and you don't have enough of your traditional fossil fuels going on. So there is a race pushing prices higher and getting more of the dirty stuff into the market than was intended. So it is the law of unintended consequences where we've declared war, we've created scarcity, and now prices are sky high.
Years ago, it was the Middle East that was holding the world hostage with the oil supply. Now the Russians? Is that a surprise?
Well, no, it's not a surprise because we created a situation. In 2019, crude oil production in the United States, and this is the year before COVID, peaked at an all-time high of 12.5 million barrels a day. Now, a good deal of that production was taken offline during COVID as demand cratered and as oil prices went from $50 a barrel to minus $40 a barrel. But prior to that, in 2019, the United States was the power. They were the swing producer. At one point, production peaked at over 13 million barrels a day. We were the largest crude oil producer in the world. We were a net exporter 2 out of every 3 weeks, to the point where every barrel we imported, we exported 2.2 million barrels. What's happened since? We've given away this comparative advantage. United States industry, steel mills, smelters, factories benefited from unparalleled comparative advantage with access to the cheapest energy in the world. We've given that all away at this point. So now, today, the United States is a net importer 4 out of every 5 weeks, and for every 1 barrel we export, we're importing 7.7 barrels. So we've completely given away our advantage, and we've given it back to OPEC. We've given it back to Russia. We created the situation we are currently in.
All right, can you hold on for a couple more questions?
Yeah, absolutely.
All right, this is Stephen Schork. He's the co-founder and principal of the Schork Report. It's a daily subscription newsletter on the energy, cash, and financial markets. And what we can talk about next is, when is this going to hit the economy? These escalating gas prices. When are people going to start putting off spending money on other things, and it's going to affect the overall economy, and in what way will that happen? More coming up.
John and Ken, KFI. John and Ken Show. John Kobylt and Ken Chiampou, KFI. AM 640, live everywhere in the iHeart Radio app. We continue with Stephen Schork. He's got a newsletter that you can subscribe to, the SchorkReport.com. That's spelled S-C-H-O-R-K, Schork Report. He's the co-founder and principal of the Schork Report, and he writes about energy and financial markets. And we continue talking to him about the incredible gas price increase and the price of oil. How is this going to reverberate through our economy? Because energy is the center of everything.
Yeah, it's a mess right now. Gasoline prices, peaked today at an all-time high of $4.20. This is even before we get over to the rollover to summer-grade gasoline, which will add another 30 cents to the price. So now we're talking $4.50. And as I stated before, 16% probability we could get to $150 a barrel. So now that brings us to a national average of $5.05 to $5.20.
Well, out here, that's going to mean over $7.
Oh, easily, because this is a national average. And so what's important about that $5.20 is it's going to match the all-time record high real price of gasoline, which was achieved in the summer of 2008. Now, when we adjust for inflation, $5.20 will be at an all-time high. And of course, in 2008, while yes, the housing crisis was the start of the recession, we have to keep in mind that summer oil prices hit $150 a barrel, and we know what happened. And in fact, every recession, beginning with the Arab oil embargo in 1974, the 6 recessions that have occurred have all been preceded by a significant rise in energy costs. And we're there right now. So the only difference a little bit is that in 2008 and before, we knew that the pressure point, the inflection point for demand destruction was around $3.60 to $3.80. That vulnerability is not quite there. The elasticities have changed because we have substitutes in the market, EVs, of course, in hybrids, but still at $5 a gallon, I don't care, even for hybrids, that's going to cause a significant amount of pain for the consumer, as every dollar that goes to gasoline is a dollar that doesn't get spent elsewhere in the consumer economy, keeping in mind that consumer spending is 70%, 70, of the U.S. economy. So we are playing on fire, and at this point, at these prices, it's hard to see how we can avoid a recession.
Well, the price of everything will go up because of transportation costs.
That's going up. And let's keep in mind, I'm sure people, a lot of people don't realize this. Our war on natural gas is a war on food production. Natural gas is the key blend stock, the key feedstock in the production of ammonium nitrate, fertilizer, which increases the yield of crop yields. We're already getting reports here in the United States that the yields are miserable because the cost to the farmer is so high because fertilizer prices, because of the war on natural gas, fertilizer prices are through the roof, making it that harder to get seeds into the ground. So that is also going to feed. So we are looking at significant inflation to continue, both from an energy perspective at the gas pump and at the grocery counter.
And I've read that there are 6,000 products that contain petrochemical variations in there as their ingredients. 6,000.
Yeah, we have to keep in mind, I mean, a barrel of crude oil is just a jumble of hydrocarbons that get refined, that get distilled. A refinery is a big tea kettle, and you boil the crude oil and you siphon off all these hydrocarbons that go into the petrochemical industry, that go into the fertilizer industry, that go into construction, that go into steel process, and a myriad of other events. So a war on energy is a war on the U.S. or on anyone's economy.
How much is this going to break Putin?
It's a game of chicken at this point. Certainly, what we saw today with the ban, a U.S. ban, and I believe the UK is joining that ban on Russian imports. And of course, Putin followed it up with said, "Okay, you want to ban my stuff? I'm not going to sell it to you." Anyway, that's certainly going to be a driver here, and it certainly is going to hurt him. But let's keep in mind, over the last year, United States dependence on Russian oil, Russian crude oil, and Russian petroleum products jumped 24% to a all-time high of nearly 250 million barrels. So Putin has 250 million barrels of petrodollars that have flown into his war chest over the past year, which is helping to fuel his little adventure here in the Ukraine. So it's who cries uncle first? Will Putin cry, or will the West will? Given that the West can always print itself with its fiat currency out of its doldrums, our money's on the West. They'll be able to wait Putin out.
Do you think Biden will do anything about this? I mean, now he's talking about going to Venezuela or Iran for supply. Will he do anything that will more directly impact American consumers?
Look, I did not think Biden in his foreign policy could be any worse than what we saw with the Afghan withdrawal debacle. Now, that was worse because the blood of 13 Marines is on his hands due to his ineptness and his lack of forethought. Second to that foreign policy blunder is now this foreign policy blunder. The United States would rather talk to terrorists than Texans. So we're negotiating with Iran, a country that the U.S. State Department has listed as an official state-sponsored terrorism since 1984, and now we're going down to Venezuela. So we keep on hearing, oh, they're talking to Iran, they're talking to Venezuela. In the president's State of the Union address, it was 7,000 words. It was 1 hour long. He did not mention domestic crude oil production once. So he is yet to talk to his own industry. And in fact, in his speech today, he did mention the oil and gas industry, but it was only to scold them and tell them, you know what, guys, because of Putin, you better not profiteer. You better not wrap up courses. So he's already planting that seed that big oil is some nefarious monster out there that is going to jack up prices when clearly the price is only going up based on the economics. And he's setting the table. If oil prices are not lower by the November midterms, he's setting the table to scapegoat their favorite target, and that is big oil, simply because we'd rather talk to terrorists than Texans at this point.
Yeah, Stephen, today he mentioned 9,000 leases have been approved by the feds for federal land drilling, and they're just sitting there. What's your response to that?
It's a specious argument. Yes, there are leases, but we don't know what kind of acreage there is. We don't even know on those leases if there's oil and gas. That oil and gas has to be explored. You have to put a pipe in the ground. Have you looked at the price of steel tube and steel? Last year, at the wholesale level, it had the sharpest rise in cost ever. So that steel, it's concrete, it is labor, and those costs are rising. So yes, those leases are there, but it's going to cost a tremendous amount in the price of commodities inflation and labor inflation to get that oil out of the ground. So yes, it's there, but every time you try and explore a lease, guess what? You get a court order from the ESG that's going to block you. So, yeah, the leases are there, but we're talking about because of the legal ramifications of the ability of the Green Movement to sue and delay this, those leases, even if we went full bore, we wouldn't see that oil on the market for years.
Well, before you go, is there one thing Biden can do that would have some kind of real effect on the prices?
More oil production in the U.S.
Yeah, absolutely. Have a meeting of the minds. Bring in the CEOs of Chevron, of BP, of Shell. Have an optic there, and then that you are talking to the industry and you are encouraging them. Throw them an olive branch. Stop doing all this. Oh, the cure for this predicament is to invest in renewables. No, the cure for this is to get more U.S. production to the market. And the best thing he could do is talk to the market and let that be known publicly. And he is reticent to do that. And I tell you what, he has given oil traders no reason to sell. He is an oil bull's best friend at this point.
All right. Thank you very much, Stephen Schork, for coming on with us.
All right. It's great to be here. Thank you.
All right. He's the co-founder and principal of the Schork Report. It's spelled SCHORK, a daily subscription newsletter on the energy, cash, and financial markets.
I want to get into the Michael Schellenberger stuff, too.
Yes.
About the Russians. Russian